Well, a warm welcome everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial. Today we have Chris O'Brien from Alexander Funds. Chris supports the portfolio management at Alexander Funds with responsibility for coverage of corporate and securitized issuers across both public and private markets. He undertakes due diligence on new and existing holdings, monitoring the asset performance to mitigate potential credit risk, and contributing to the relative value of the assessments. He holds a Bachelor of Commerce with honours in Finance from the University of Melbourne and is also a CFA charter holder. But before we get stuck into our discussion, I would quickly like to provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statements regarding the financial product for further information. Details of this general advice warning can be found at the moneysmart.gov.au website.
Well, thanks for joining me today, Chris. As a fund manager specialising in credit, income and yield, can you talk us through Alexander Fund's history and investment philosophy?
Yeah, sure. And thanks for having me, Joel. I think in terms of sort of the investment philosophy, investment process, it is worth touching on the history of the business and the background of the two core or senior portfolio managers being Chris Black and Adam Scully, since their background and their history really flows through to the philosophy of the firm and how we look to invest money across our funds. So Alexander Funds in its current form has been around for a little bit over a decade. And prior to founding the business, Chris Black, again, one of the senior PMs, his background was running credit trading operations for offshore investment banks across both North America and Asia for a number of years. And in those roles, he was investing the bank's own balance sheet money and their cash to generate a return in credit markets globally. And in that sort of role, you can probably imagine there's a heavy expectation that you make money year in, year out. And if you don't do that, if you're not generating a profit, you can be moved on fairly quickly. And because of that background, Chris's philosophy and the philosophy of the firm and the team more broadly that's carried through to this day is firmly grounded in an absolute return mindset. And what I mean by that, just in normal people's language, all we mean by an absolute return mindset or an absolute return approach is that we look to generate a positive nominal return each year within our funds, regardless of what's happening in macroeconomics or the macroeconomic environment or in financial markets more broadly. And to do that, obviously it's an easy thing to say, it's a harder thing to do, but to do that, we're firm believers that you need a broad palette to paint with. And what I mean by that is you're not siloed either within your mandate or the expertise of the team, you're not siloed to any individual segment of the credit market. You've got the expertise and the knowledge and the mandate within the fund to traverse the entire credit universe and pivot to that pocket of the market that's currently offering attractive risk-adjusted returns, essentially.
So Chris, with that being the credit market being so broad, what's the investment process you use to identify the opportunities?
Yeah, sure. So it's really, in its simplest form, it's really a two-step process. The first step being a top-down approach. And that involves our investment committee, which meets formally on a monthly basis. We're speaking with them and dealing with them day to day and multiple times each week, but it meets formally each month where we set the overall risk outlook or risk positioning of the funds moving forward. And that risk positioning can be set to either positive, neutral, or negative. And it takes into account the typical things you'd expect. What's the economic environment domestically? What's the economic environment offshore and in key developed economies globally? Is there any risks present within financial markets or particular segments of the financial market that could be a catalyst for a sell-off in risk assets? And all of those things are taken into consideration, which I guess are more fundamental. But it also takes into account pricing within different segments of all risk assets, but particularly credit. So what segments are priced attractive relative to historical norms and what segments aren't. Once that discussion and analysis has been completed, like I said, there's an overall risk outlook that's set for the funds, which can be positive, neutral, or negative, but there's also views formed on individual segments of the credit market. And that sets the parameters of which we can invest in for the upcoming month. It impacts the amount of credit risk we're able to take and that we're willing to take within the portfolio. And it impacts the amount of spread duration we want to be carrying in the credit opportunity fund. And it also, like I said, it impacts and informs which segments of the market we want to be investing in at any point in time. Now, once those parameters are set, once that top-down approach has been set, the individual security selection and asset selection process is really based on bottom-up research conducted by the team, which we're essentially looking at. One, are we comfortable holding exposure to a company or an issuer from an absolute risk perspective? And then two, are we being compensated well enough for that risk?
So with the risk, so you mentioned a number of factors that you take into account. Do you have a proprietary in-house risk system you're using to gauge the risk, or are you relying on external factors that then feed you that information?
Yeah, we do. So we've got an internal risk system or risk systems that have been built over a number of years. They're developed and maintained and enhanced by our head of data analytics. His name's Dr. Matthew Oldham. He's got a PhD in computational science from the US. And that system is really, really important and powerful for us in terms of being able to analyze and report on the risk metrics of individual securities, but then the portfolio as a whole as well.
Okay. Well, what are the opportunities and risks you see in the marketplace at the moment?
Sure. So I think in terms of the risks present, we really see our portfolio as being exposed to three key arms of risk, broadly speaking, being credit risk, liquidity risk, and market risk. So just running through those quickly one by one. Credit risk or default risk. In lending and fixed income credit funds management, that's always going to be your number one concern. And that's basically, what is the risk that we don't get the money back that we've lent out to someone, both principal and interest obligations. That's mitigated through our internal underwriting process. Liquidity risk. So we operate, the Credit Opportunities Fund is an open-ended fund. Investors can request a redemption or offer their money back on a weekly basis, whether it be for personal reasons or they want to buy a house, a car, or maybe they just don't want to invest in the product anymore. And that means we need to always make sure, and we're always very conscious of carrying enough cash and liquid securities in order to satisfy those redemptions as they come up. And then the third risk, and the one that's probably most pertinent and relevant to the current market environment, is what we refer to as market risk. And I think for those who don't or aren't looking at fixed income and credit markets every day, this might be the one that's a little bit less intuitive. I think credit risk and liquidity risk, everyone can sort of understand intuitively, but market risk in its simplest form, all we're referring to there is like the share market where shares are trading daily and the share prices of those shares can change daily. Bonds in the credit market also trade daily. They're just traded between institutions over the counter as opposed to on the stock exchange. And the price of those bonds can change through time. Now, the largest impact or the main factor that impacts the price of bonds in credit is credit spreads. So credit spreads being essentially the extra premium or yield an issuer has to pay or a company has to pay to investors in order for them to buy their bonds above the risk-free rate. If the company's deemed or viewed as more risky, they're going to have to pay a higher credit margin and credit spread for those bonds. Now, if we look at across the last 2 years, and I should clarify that as credit spreads tighten or as they decrease, bond prices in the credit markets increase and vice versa if spreads widen and the credit spread demanded by the market increases. Now, across the last 12 to 24 months, it's quite clear that risk assets have performed incredibly well across all market segments. If you look at equities, particularly internationally, have performed quite well and arguably priced quite expensive relative to historical levels. And credit has experienced a similar phenomenon, maybe less pronounced, but it's still been present, where credit spreads have been compressing and decreasing a lot across the last couple of years, which has caused the bond prices to rise in that environment. Now, if we're looking at that relative to historical levels, it means that you're not necessarily being compensated as much either by stepping down in credit quality to a lower credit rated bond. The extra yield you're getting isn't as great as it has been historically, and also extending credit duration. If you're buying a longer dated bond, which is generally viewed as more risky, the compensation in terms of extra yield and extra spread is less than it has been in the past. And that's something we're very cognizant of and conscious of at the moment, in that if there's a catalyst that causes credit spreads to widen, that can create a headwind for our portfolios and the portfolios of credit managers sort of across the country, really.
Okay.
And in terms of opportunities, I mean, it's natural that we're always thinking about risk since we're a fixed income manager, but there is also opportunity still present in Aussie dollar credit. So alongside that compression in spreads across the last couple of years, there's also been a growth in the overall bonds being issued, both in terms of overall volume, but also the diversity of issuers coming to the market. So increased Australian companies are electing to issue bonds here, as opposed to in US dollars or euros. And similarly, we're seeing more international businesses come to Australia and issue bonds in Aussie dollars, which presents an opportunity for us to diversify our pool of investments.
Okay. So with Alexander Funds, what are the greatest strengths you guys have as fund managers?
So I think there's a couple, but there's a few, but a couple I'll touch on specifically. Our risk systems, which I've sort of already spoken to, which have been built in-house and inform all the decisions we're making on a daily basis within the portfolio. But another one is the level of experience across the organisation. So if we look at the two primary portfolio managers being Chris Black and Adam Scully, Chris has got over 30 years experience in the credit markets. Adam's got over 25 years experience in the credit markets. And then in addition to that core or the core PMs, our investment committee, it's probably quite unusual for a business of our size to have that level of expertise available to us. So people like Nick Bishop, who previously ran or was head of Australian fixed income at Aberdeen, Chris Dalton, who was head of Standard & Poor's Australia for a number of years and is a stalwart of the Australian securitisation market more generally, and then Jared Minak and Steve Roberts also have prominent profiles as economists as well. So I think having access to that depth of knowledge is really powerful and helpful for us as a team.
Okay. Can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turned the performance of the investments around?
Sure. So I think probably the most recent period where the returns of our funds was a little bit more sluggish was 2022. And that was a period, if we cast our minds back, risk assets across all segments of the market probably underperformed. Equity sold off, credit sold off, rates sold off. And that was due to concerns around the steep inflation that had emerged across the developed world and the aggressive policy response that was emerging from central banks globally. Now, we were a little bit insulated in that all of our portfolios are floating rate instruments, so we don't carry interest rate duration. So we weren't hurt by base rates increasing, but we were hurt by credit spreads increasing at that time. Now, what we were able to do through that period is heading into it, once we identified early that it was, I guess, a risk-off environment, you'd say, we pivoted a large portion of our portfolios in what's called the structured markets to short-dated AAA securities. Now, when risk assets are selling off and credit spreads are widening, those sorts of assets being high credit quality and short credit duration, the price impact or negative impact to them from spreads increasing is smaller. Now, that meant we were able to somewhat insulate our portfolios across that period, but more importantly, since they were short-dated bonds, we were receiving a lot of cash back from them 9 months, 12 months after purchasing them, which meant the portfolio was cash generative, and we were able to reinvest that money at those cheaper prices in the credit market. And subsequently, that meant we were able to rebound well in 2023 and 2024, and the performance of the fund across that period was much improved from 2022.
What type of investments have you made in the fund recently?
So, I mean, there's a number, but a couple of which I'll call out specifically. I spoke to the expansion of issuance volumes in Aussie dollar credit across the last 24 months. Some of that has come from international banks, large global banks, issuing both senior bonds and subordinated bonds here. And there's a couple of good things about that, which we've been able to take advantage of. One, you're diversifying your pool of instruments and issuers you're exposed to, which is good from a risk perspective. But two, for those issuers that are either new to the Australian market, or they might not be new, but they haven't issued here for a number of years, they'll often have to pay up a little bit of a premium in order to establish their credit curve and establish the program and get investors interested, since they haven't come to market for a long time. And that presents another opportunity for us to take advantage of that pricing premium.
Okay.
Now, the second one, I guess I'll mention is where we continue to be active participants in the funding of the non-bank financial market in Australia. I think everyone, or a lot of people would be aware that's a growing part of the economy, and they source a lot of their funding either from what's called the private warehouse market or the securitized markets. And we're active participants in both those pools of credit.
Okay. Now, you spoke before about the risk management system you have. How else does Alexander Funds keep up to date with changes in financial markets?
We'd probably be similar to a lot of other managers in the space there. So, one, we've got internal expertise on our investment committee, which are quite well connected and report industry developments, whether it be in regulation or for a specific sector, back to us on an ongoing basis. But outside of that, we have data feeds from Bloomberg. The rating agencies are very important and very helpful in our asset class. And then also the counterparties that we trade through. So we trade bonds through dealers. So most of them are either the major banks here or international investment banks. They provide a lot of colour on what's happening in the secondary market for bonds, which is also helpful.
Okay. And what makes a good portfolio manager overall, Chris?
That's a tough question, but there's probably a number of attributes. But if I had to pick one and talk to one, I think this is probably consistent across all asset classes, but it's particularly important in credit. It's an attention to detail and being across that detail within your portfolio. So credit and fixed income is a little bit different to say equity fund management, where we're not paid for upside in our asset class. There's no blue sky. We're just paid and we're looking to collect a coupon on the assets we invest in, perhaps with a small amount of capital appreciation if we buy the bonds at a discount. But outside of that, we don't get paid for the upside for a company. And that means everything we do, the first consideration and the basis of all our discussions is focused on risk. And I spoke to earlier the three broad categories of risk we face, being credit, liquidity, and market risk. But even within those broad categories, there's a number of subcomponents that feed into that overall risk that you need to one, understand, but also be able to quantify. So if we take market risk just as an example, there's a number of components that feed into that and can affect the performance of your fund and your securities in that area. So you've got things like interest rate duration, credit duration, basis risk, swap spread risk, extension risk, depending on the security types. And you need to understand all those individual elements and be able to measure them for each of your holdings and the portfolio as a whole. Because if you're not across that detail, that's where securities that you hold and the portfolio as a whole can behave in unexpected ways. And that's when you can get burnt in this space. So yeah, I think being across the detail is critical as a credit fund manager.
Chris, we've spoken about a lot of things through this session. Is there anything else you'd like to add?
I don't think so, Joel, other than to thank Solace and your clients for the ongoing support. We really appreciate it. And, if there's ever any questions or information your clients want to know about our funds, we're always happy to provide or jump on a call if it's helpful.
Perfect. Chris, I appreciate you making the time to talk with me today.
Thanks very much, Joel.
Chris, I appreciate you making the time to talk with us today. If you'd like to talk to Solace Financial regarding your current financial strategy, and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Until next time, we'll be watching.